I mean, really Russia's invasion of Ukraine and the energy crisis that followed reshaped the conversation, and suddenly people were saying, oh wow, there's actually this stuff called commodities, and there's this commodity called gas, and it comes from Russia on a pipeline to Europe, and they didn't really know about this. It got very real again, and that's manifest here in a number of ways. I mean, I feel like this conference is bigger than it's ever been before. It feels it's always been a great summit, but it feels kind of year after year increasingly dynamic, and that's been kind of good for our coverage. I mean, I do think in general we're writing more about these sectors.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Abax Exchange, bringing you better benchmarks, better technology, and better tools for risk management.
Welcome to Scenes from the FT Commodities Global Summit in Lausanne 2024, a special episode of Smarter Markets. I'm Dave Greeley, Chief Economist at Abax Technologies. Smarter Markets was back at the annual Financial Times Commodities Global Summit in Lausanne, Switzerland this April, where the conversations focused on how commodities traders and markets are navigating the new commodities world order. We partnered with the FT to interview a wide range of commodities market participants to ask them how the big developments being discussed at the conference this year, including the pressures from the energy transition, technological innovations like AI, war and geopolitics, changing government regulations, and the end of easy money were affecting the commodities trading landscape and the way the trading was getting done. We also discussed the ways that markets and market infrastructure need to change to keep pace with the changing commodities trading landscape and what new tools and technologies would be most useful to their businesses. We've compiled a selection of those 8 interviews into this special episode of Smarter Markets. If you'd like to listen to the full interviews, they are available on our website, smartermarkets.media, on the Smarter Markets Presents media page. They're also available on our second podcast channel, Smarter Markets Presents, available on all major podcast platforms. Our guests in order of appearance in this episode are Tom Wilson, Natural Resources Editor at the Financial Times; Simon Collins, Chairman of HC Group; Halima Croft, Global Head of Commodity Strategy and MENA Research at RBC Capital Markets; Brian Manel, Chairman and CEO at TechMet; Amrita Sen, Co-founder and Director of Research of Energy Aspects; Jason Tate, Head of European Power Trading and Origination at BP; Michael Curran, Head of Environmental Products at Vitol; and Alistair Weir, Head of Environmental Markets at Abax Exchange. We hope you enjoy these scenes from the FT Commodities Global Summit in Lausanne 2024. We're back here at the FT Global Commodities Summit in Lausanne. I'm honored to be joined by Tom Wilson, Natural Resource Editor for the FT and also the host for this week. Tom, there's a lot of really interesting topics being covered this week in Lausanne, major lists of developments in global commodities trading, talking about energy transition, AI, technological advances, geopolitical tensions, war, everything else. I was curious, when you were putting together the agenda for the week, how are you thinking about what you wanted to cover and what you wanted people to get out of the conference this year?
I mean, I think to your points there that you made in posing that question, you kind of got to the heart of what we've been talking about this week, is just how complex the commodity trading landscape has become. So you have this intersection of geopolitical change, regulatory change, and then energy system change, and kind of one layered on top of the other means there are a huge new number of variables and dislocations in the market which are affecting the way in which commodities move around the world. In other industries, one might say, oh God, that's a problem for business. I mean, the thing about the commodity trading sector in particular is that traders thrive in those dislocations. And so we've seen those disruptions result in huge profits for the sector over the last 2 years. I mean, all of the privately held traders have seen massive jumps in their profitability. So, circling back to your question, I mean, I think in putting together the agenda, we wanted to really try and draw out the big themes, identify kind of how the world had changed, and then kind of throw it forward and ask, whether the last 2 years are kind of a unique moment, driven principally by the war in Russia? Was there something kind of unique about in the characteristics about Russia and that war which led to the levels of disruption we've seen? Or are we actually going to see this level of disruption either sustained or repeating on itself over the next 10, 20 years? And that's, I guess, the question that we're trying to answer. And that's in the energy transition in particular. We're seeing a couple of trends there. I mean, over the next 30 years, we're going to see a massive shift in the way in which we consume energy. So that is going to result in a whole new kind of suite of energy products being consumed by the world. So more power in time, kind of more biofuels, more synthetic fuels, more hydrogen. That's going to require more metals to be produced in order to kind of build out lots of those commodities. So I mean, I think that is kind of underpinning this, and I think that is kind of a fundamental change. I think also customers are becoming more concerned about the provenance and content of the commodities that they consume, either for political reasons, i.e. now I don't want a barrel of oil from Russia because of the sanctions and the kind of moral position that the West has kind of taken on the war in Ukraine, or because of regulatory reasons, so because of a need to kind of cut emissions and they want to know the kind of carbon content. And I mean, I think these are things that consumers of commodities weren't thinking about in the same way as if we were back 15 years ago. And as a result, if you go back to, say, the 1990s, I think probably more likely that a commodity was just going to move in the most efficient way possible from A to B over the kind of shortest supply line to command the highest price. But now there are these other considerations which are going to force commodities to move around the world in a less efficient way. And then commodity traders are going to need to step in to help manage that.
And I wanted to ask, you raised two really important points, and I wanted to ask you how it affects you in your role as an editor for natural resources at the FT. And that is, one, the range of natural resources that impact your reader is really broadening out. There's so many, whether it's looking at the battery metals and people needing to understand lithium and cobalt markets and nickel markets in ways they probably didn't need to, 5 years ago. And then also that when you look at the provenance of commodities, a trader might want to know where the particular commodity they're buying came from, but probably the person on the street's also more interested of, okay, what are the implications of the things I'm buying every day in terms of the environment and the other things I care about? How is that affecting how you're thinking about, your coverage of the sector?
Yep. I mean, I think the last point you made in particular is kind of particularly pertinent, that the person on the street is getting more interested about the provenance and content of the materials they're consuming. For someone who writes about energy commodities, that's a really positive thing, because it means that, a corporate story about a copper producer might be relevant to the general reader in a way that it potentially wasn't 10 years ago, which is exciting for us as journalists, or at least those kind of in my team, because when you're writing stories, you can write them for a broader audience. And so I think that's been a really important development. I mean, I think in general, in terms of the FT's energy and commodities coverage, we've covered this sector for decades. I mean, I presume we've covered this sector since we were founded in the late 19th century. I do think probably, though, that if you went back to, say, the kind of post-financial crisis, 2008, through to even the end of the last decade, there was a sense, at least in kind of the West, that the world was moving post-industrial, and that, what were people interested in? People were interested in the latest technology. People were interested in the latest social media platform. And I think that to some extent manifested itself at the FT when we were hiring new reporters. It was often, let's have a crypto reporter, kind of, for example. And then, really Russia's invasion of Ukraine and the energy crisis that followed reshaped the conversation, and suddenly people were saying, oh wow, there's actually this stuff called commodities, and there's this commodity called gas, and it comes from Russia on a pipeline to Europe, and did everybody know about this?
It got very real.
Yeah, it got very real again. And look, and I think that's been good for look, that's manifest here in a number of ways. I feel like this conference is bigger than it's ever been before. It feels kind of, it's always been a great summit, but it feels kind of year after year increasingly dynamic. And that's been kind of good for our coverage. I do think in general we're writing more about these sectors.
Simon Collins, I'm chairman of HC Group, and I'm also an investor in technology related to commodities. So I think there's a dilemma of the trading companies with respect to technology, right? So do they build their own, or do they bring in third-party applications, and then which third-party applications there are? Quite a few of the CTOs that I do regularly talk to within trading companies feel like they're bombarded with different solutions externally, and they also have a quite high level of hesitancy given the value of their proprietary data. So do they build their own, which is not their core competence, or do they take third-party applications, and then they have the issues around integration and data security, That's the key issue.
And these are very risk-focused organizations. As you said, data is very proprietary, very important. How do you think they're thinking about the security of their own data and willingness to allow it to be accessed by things like some of these large language models?
Well, I can tell you, I mean, some of the larger companies, obviously they're working over different jurisdictions, and we're looking at deglobalization of commodity markets generally. So even between their offices, they are restricting the data which is passing, okay, between the Far East, the Middle East, Europe, and the US, right? So, there's a challenge there in terms of segregation data just internally, and they're very sensitive around that. And as to externally, well, my experience so far is that they'd be very, very keen to ingest more data, okay, but to give data out is a completely different story.
And speaking of how traders use that information for part of their strategies, how do you tie it to their existing workflows? So, traders have tools they like to use. People get comfortable looking at data their way, using applications like IceChat, WhatsApp. I think you spoke in the panel a little bit about that as well. Like, how do you integrate all this together to make it more usable for the trader?
Yeah, so you've got multiple systems which the trader is using, and when you go into a trading office, you see with his tree of screens, 6 screens, 8 screens, right? And then you ask him, so why do you use that screen? And he'll say, I need to see that piece of information, which is one cell of 100, etc. So they definitely have issues with that. The fallback is always Excel, right? Which was really, in many ways, was never built for that kind of purpose, particularly in terms of picking up price data and feeding that into an Excel sheet and then trying to share that with the team. So, of course, the larger the company, the bigger the tools being built. But, generally my experience of a physical trader is he doesn't have a lot of good access to the system. And what he needs to do is he needs to fall back, and he goes back to the risk people and he asks them, okay, so what's my position? Where am I long? Where am I short? What's the VAR, etc. Because he doesn't have those tools with the existing applications that he has, whether those be in-house or third-party applications, to have good visibility over his trading position.
I think for people who are from the outside, that's often kind of amazing that the trader wouldn't have good visibility into his own book, his own positions. How common is that?
Look, from my experience, it's very common. I'm not saying they don't know the position. They do know their position, but they need to go back and check in detail with the risk people, because the systems that they use don't really give them the accurate information that they have. And frankly, they're not particularly user-friendly, right? So there's a lot of areas where, for example, not to use too much jargon, but to improve the UI and the UX, which is everything that we talk about in consumer goods when it comes to technology, is everything that we don't talk about when it comes to, software systems for businesses, right? So, when we look at some of these incumbent CTRMs, for example, they look like they're built from the 1980s and nothing changed since. On the trading side, I think the more efficient you can become through technology, the more granular you can become as well. One of the businesses I'm invested in and I'm a director is Edge Petrol. And what we do is we do data analytics for petrol retail stations. So we sell our software to mom and pop operators, and basically we capture the purchase invoice, we capture the inventory data, and we capture the data at the till. So every time there's a fill up of a car, we capture that, right? So what we can do is we can calculate what we call the real-time mark-to-market of the petrol retail station. He can see exactly what his margin is at the price that he's showing on the pole at that given moment. And that data he didn't have before. So we're talking about real micro trading. And then beyond that, that for me is data analytics, but beyond that, we can start to use AI. So he can start to ask the system, okay, if I increase my price by 2 cents a litre or 3 cents a gallon, am I going to make more money or less money? And because we have that historic data and we have different scenarios, we can actually start to tell them, well, actually, based on the historical data and the elasticity of demand in your area, if you increase the price, you're going to drive down volume and you're going to make less money. So what you're better off to do is to decrease the price by 1 penny a litre, and then you're going to start to see more traffic being attracted to your site. So it's just a very simple example of an area which is only 4 products, 96, 98, diesel, super diesel, right? And very generic. But it goes to show you that if you use technology, you can dive deeper into the market. You can get more granular and you can be more involved. And as I raised on the panel just now, I mean, in the bunker market, we see that the traders, they need to be involved, but really it's not a great business for them because it's so small. And as a trader myself, we always had rules around, okay, what is the minimum tonnage that we would trade? Because we knew if we traded less than 100 tons of copper, we're actually not going to make money because the margin on the business is too small and the processing costs are too high. So if we can reduce the processing cost, we can significantly increase the market share that we have. If you think about it in the context of Google, right? How do they make money? They make money from ad revenue, which is 0.01 cent per impression, right? So we need to improve the efficiency of the commodities industry so that they can basically proliferate to the market better in a more efficient way.
My name is Halima Croft. I'm Global Head of Commodity Strategy and MENA Research at RBC Capital Markets.
What is the scope for the U.S., for Europe, for the West to act? We saw, taking a step back when Russia invaded Ukraine, sanctions on Russia, but the need to keep oil flowing, to keep energy flowing, kind of constrained.
It constrains action. I mean, I think this is, for a larger discussion, and I think a really important discussion, is the degree it's been a limiting factor on multiple American administrations. But we've certainly seen, we're 2 years into this war, that from the outset, a clear goal of the Biden administration was to penalize Russia, but keep the oil on the market. So think about the first round of sanctions where we sanctioned the Russian central bank, the first time a G20 central bank had been sanctioned. And yet we did exemptions for energy transactions. Same thing when we disconnected the major Russian banks from the SWIFT payment system, exemptions for energy. And we think about price caps. Price caps are a response to the EU6 package of sanctions, the ban on the provision of services to move Russian barrels that were not going to be welcome in Europe to third markets. In many respects, it was an inflation reduction measure to prevent a major disruption of Russian oil. So the question going forward is, what is in the administration toolkit? We have not significantly tightened enforcement of oil sanctions on Iran, despite the fact that Iran funds these groups that are causing such disruption in the Middle East. When it comes to Russia, we really haven't gone after meaningfully Russian oil revenue because we fear Russian supply disruption. And you look at the latest Russian budget, where they're just spending 6% of GDP on the military and defense, one of the largest Russian defense budgets in history. It's based on a revenue projection that shows a 1/3 increase in Russian revenue. So the question is, has the policy of allowing Russia to retain significant energy revenue prolonged this crisis? And the question is Ukraine basically saying, if you do not give us aid and weapons, the United States being held up in Congress, should we put energy on the table? And we've seen since January a number of attacks on Russian refineries, disruption of Russian product flows. That has not pleased the American administration. The question is, if we do not get the $60 billion released from Congress and the potential return of President Trump, where you could see, further cutoffs in terms of U.S. aid to Ukraine, does Ukraine decide that they have a limited window to defund Russia? And so are these attacks that we're seeing on the refineries, does it expand to actually target export infrastructure? I think that is a really big wild card as we head into summer.
And so as you look, ahead to summer, oil prices, energy prices, what does this all mean? We've already seen oil prices starting to head back up. What do you think in terms of prices and volatility?
It's a lot of potential volatility. And the question for the Biden administration is, if you cannot bring these wars to an end, and it's obviously not the case that the Russia-Ukraine war is going to come to an end, but if Ukraine persists in their attacks on energy infrastructure, so if they do not believe that the aid from the West is material enough to keep energy off the table, so if this pattern continues or potentially accelerates, if the war in the Middle East continues, what's in your toolkit? And so I think obviously there'll be appeals to OPEC going to that June meeting, so it'll be an all-important June meeting. So it is the classic phone call that successive American administrations have made, where you get on the hotline and you call Riyadh. And remember, with the American energy revolution, we told ourselves those calls would not need to be made. And yet, I think it'll be another round of energy diplomacy. And if that does not yield enough barrels to cool this off, and you're looking at retail gasoline prices well above $4 a gallon, do we go back to the SPR?
And how much is there to go to the SPR?
I mean, look, we've already drawn down by 200 million plus. And so we were supposed to be in buyback mode. That has paused. And so the question is, how is there going to be another blockbuster release pre-election? I mean, we're already 360. We're already down, to significantly lower levels. The question is, what's left in the tank to cool energy prices?
Brian Manell, Chairman and Chief Executive of TechMet.
I wanted to ask you, because it is a little confusing for a lot of people that there's such a structural need for these critical minerals. I mean, we call them critical, and yet the prices across the board have been sliding over the past year. How do you square that?
We've unfortunately caught into a market environment that is very driven by short-term supply-demand balance and sentiment. When we had excessive speculative booms in prices for lithium, cobalt, nickel 2.5 years ago, that resulted in an acceleration of easy to achieve short-term supply increases, which we're now living with. That's the one factor. The other factor is the general market environment, where the world's weaning itself off addiction to cheap, plentiful liquidity, which is going to take a while interest rates and inflation normalize and start to decline, which creates a much tougher funding environment for growth companies. It's a product of perceptions of slowdown in EV growth, demand growth, which is kind of irrelevant, in this inexorable trajectory towards entirely electric mobility over the next 10 years. There are going to be accelerations and decelerations and ups and downs, but it's not stoppable. And the Chinese are exploiting this weakness and adding to this weakness by oversupplying and overhyping their investment programs, such as in nickel in Indonesia, in order to further depress markets, deter other people investing in new capacity, and ensure that when we wake up in 3-4 years' time, their global control of these critical minerals has become even greater. It's a rapidly evolving environment certainly with respect to traceability and the deployment of blockchain and AI systems with respect to monitoring and managing data in supply chain, which is really important. In terms of exploration, in terms of mining technologies, in terms of process technologies, there's a lot of work being done to help our industry transform itself to meet the demands of the energy transition, which is a big transformation, not only in terms of volume, but in terms of standards, in terms of carbon footprint, in terms of geopolitical independence. We certainly need to transform markets for minor metals. The present markets and hence price discovery and transparency and ability to manage risk are very immature for lithium, for cobalt, and virtually non-existent for tungsten and rare earth metals and vanadium and other metals that we're involved in, which are critical to the world in with respect to this epic transformation.
Yeah, and maybe you just answered the last question I wanted to ask you already, but I was curious, where do you see the biggest opportunities to improve markets by making them smarter, better market infrastructure, better financial technology? Where do you see the big opportunity to improve our markets?
I think across the board, what ABAX is doing with respect to products, with respect to a platform that facilitates the efficient trade and management of risk across metals that have not historically been liquid and transparent in terms of market is absolutely crucial.
I am Amrita Sen, co-founder and director of research at Energy Aspects.
I wanted to talk a little bit about the markets and market infrastructure side, because we're kind of moving into a world, right, where the definition of energy is changing a bit, right? Energy transition, so much more is electrification, that's much more about metals. And I'm curious, when you look across, the markets you cover, what areas do you think need more coverage and more information, more data? And where maybe even do we need better markets?
Yeah. I think, look, in general, the more visibility we have, and I would say it's oil products more than crude. Like everybody talks about crude oil, right? But you and I don't pay for crude oil. We pay for gasoline and diesel and so on. We still have a lot to do with ship movements. We can't differentiate between that or storage or just generally even demand numbers. So many of the demand numbers we get, by the way, have tertiary storage included in that, or just movements within tanks included in what is demand. That's not demand. Much better data is required on actual vehicle miles traveled. That's very sparse still. Separating that with trucks and cars. And we're going to need that even for transition, right? To know, okay, EVs versus hybrids versus ICE vehicles. That's going to be important for even governments, because guess what? Right now, say the UK government gets £23 million from ICE vehicles and zero from EVs. At some point, they'll need to start collecting from EVs as well, right? So in a nutshell, it's the demand side that requires far more data. And that's where the markets also could do with better numbers, essentially. Supply side, we've done better. There's, it's easier as well. But demand side, we still don't, and we haven't done as well.
And what do you think the obstacle is for getting it on the demand side? Is there no natural collector? There's no government that's doing it. There's no International Energy Agency that's doing it. There's no producer who's required to disclose numbers as part of their filings for investors?
It's an interesting one. I mean, there is an International Energy Agency that does it, and I would argue not very well. I think the biggest challenge with demand is the definition. We haven't defined what it is, right? Supply, everybody reports it. You know what's crude, what's condensate, what's NGLs. Some people include ethane in their oil demand numbers. Some people don't include it. So I think that it's a definitional thing. So you're not comparing like for like often. Then you have places like China where, guess what? You evade taxes and call gasoline mixed aromatics or diesel light cycle oil, but then you have to add these back. So that's where it becomes really, really tricky. Also, by the way, India is another example where refineries do report. They do have to report the demand numbers, or reporting it to the government, but they only report sales as opposed to, so imagine naphtha. If the naphtha is going into their cracker, they don't report that even. So there's a general tendency to underreport because it's also domestic demand. And often we find international demand, so international refueling, international fueling of ships gets left out. So we need, I think, better standards globally.
And I wanted to ask you, thinking about where the opportunities are to improve markets by making them smarter, having better data, better market infrastructure or technology, where do you see the biggest opportunity from where you sit that we could improve markets or our understanding of markets today?
I think both technology and infrastructure, I think they go hand in hand, right? We can have the best technology, but if we don't have the infrastructure to make it available, accessible, it doesn't go well, right? Look at how trading has evolved. I think technology's played a huge part, but that's also been infrastructure. I think that's what's required in our markets. And just to kind of get better information to traders, to analysts, and then being able to execute on that, right? I think that's where information arbitrage just gets easier.
Right. And how has that changed for you over the years, that making information accessible? Because right now there's so much. And how do you, and I've always found, it's almost like the information, how it gets arranged really kind of depends on the analyst or the person who's going to be using it. It's kind of a second brain for them in a way.
100%.
And how do you bridge that gulf between what's available, on the bench and what is really customized to the individual?
I think that's one of the biggest lessons I've learned, right, running this company for 12 years, is that we often kind of come at it, this is how I would use it. Yeah. But it doesn't matter, we have 600 companies as clients and they all are different, from producers to refiners to traders. They all look at things differently, right? So I think the biggest thing is provide the data, clean up the data, provide it in a very, very accessible way where it's manipulable. You might want to, regress oil with weather, for all I know, right? Yeah. Who am I to because often what we do is we'll be like, that correlation doesn't make sense, so we will not allow it. I think that's one of the biggest lessons, that just have it in a clean format, have it in a very interactive way where people can drag and drop and you can create your own charts, your own kind of data series, and then you judge whether that makes sense or not, right? We can provide the analysis and we can say why we agree or disagree, but we shouldn't limit that. I think that's been one of the biggest takeaways.
I'm Jason Tate. I run BP's European power trading business.
I was curious, when you look across all these big developments that are happening in commodities, what are having the biggest effect on your business and how you do business?
Yeah.
Good question. First, to start off, being at the FT, this is a great conference. There's super senior folks that come to this every year, and the level and nature of the conversations are particularly interesting. What's been shocking this year is power, which is the business I'm in, has been featured almost in every panel, even though it's not the actual theme or topic of the conversation there. So I think when you think about what's happening in our industry, I think first you have to start with what's going on the generation end, right? And to no surprise, we are decarbonizing and electrifying as a society. And so with that, we're greening up our generation stack. So with that, I think no matter where you sit, you're seeing a significant amount of renewables being deployed. And with that is having a pretty profound impact on volatility, right? So for Germany, for instance, 2 weeks ago, we had Germany producing 30 gigawatts of wind. 7 days later, it's producing 7, right? And so how do markets cope with that variability is going to be, one of the major challenges. And 3 other things that are topical, at least on our minds at BP. Number 2 would be around talent, right? The human capital point. We have underinvested from a power perspective, and many other commodities may say the same. I can't speak for them, but we have underinvested from a power perspective in talent over the years. And it wasn't a bright spot coming out of uni, right? Some of the best and brightest were chasing technology, were chasing the financial sector. And but power isn't about people sitting and looking at screens either. This is, the transition is real. And, one of the phrases I just used on the panel was there's no transition without transmission. So this is going to mean people in the field. This is going to mean, electrical engineers, mechanical engineers, and so forth. And the final 2, I won't go into them, but are, very much around the regulatory landscape and then what's going on with supply chains. So super exciting in the power space.
Sounds like we need a lot more capacity. Without capacity, you get volatility, whether it's you don't have enough people, you don't have enough base load, you don't have enough flexible dispatch. When you look out across it, where do you see the biggest need for investment in your sector?
For me, I would jump to, I think it's around 2 points. One is flexibility, and we'll talk about how that takes different forms. And then second would be the grids themselves. I think this is a Bloomberg number, not mine, but that we need to replace 80 million kilometers or 50 million miles of actual transmission lines globally to effectuate what's being required. That's staggering. Effectively, that's adding a whole nother global grid on top of what we have today, right? So huge, massive investment. And there are numbers that are published around that. I wouldn't even pretend to guess how large those are. So that's number one. And then second is, how do we create flexibility across the value chain to soak up this, intermittent renewables that's going to come? And this can take different forms, right? It can be demand response on the consumer end. It can be technology there. It can be e-boilers in refineries, things that, BP will be looking at. It can be, advancements in technology on batteries and things of that nature, as well as we do need. And one of the themes of this conference is, folks saying, listen, we're bullish gas off the back of the energy transition because they know gas will be needed to help balance the grids globally. So yeah, we'll see how all this plays out.
Yeah, definitely. Well, I wanted to ask you one more question before I let you get back to it, because I know you're busy. And that's, obviously, this is Smarter Markets. We're always looking for ways to make markets smarter. And I was curious where you might see some of the biggest opportunities to improve markets with better market infrastructure, better financial technology.
Yeah, I think that this isn't about and we talked about it on our panel, we don't need a revolution of certain markets. I think we need an evolution of certain markets, and it needs to be very thoughtful, right? We need markets to function. And my fear is when you overly regulate deregulated markets, as you know, that stymies investment, right? 2 things happen. One is entities will start to add in greater risk premium, right? Which doesn't help, capital being deployed. Or secondly, the amount of, just uncertainty that goes into that market, basically detracts any capital from being deployed. And so my push would be, be very thoughtful. I'm not a policymaker, but be very thoughtful about any market redesign that's being deployed, both on existing and new, direct or foreign direct investment.
Michael Curran, Head of Environmental Products for Vitol.
I'm curious, when you look at your business, with environmental products, carbon markets. What developments are having the biggest effect on your business and the way in which you do business?
Yeah, so I think the Article 6 is going to have the biggest impact. So, your panel was on voluntary markets. Clearly, as you flagged, the voluntary markets have really had a kicking in the last 12-18 months. However, I do think that the markets have bottomed. I think that the buyers are coming back. The lack of confidence or the disappearance of confidence has waned or is waning. And I think bringing in Article 6, even though it hasn't yet been agreed at the UN level, people are acting as if it will be agreed. And therefore, that's changing how we approach things. And as I said, in terms of contracting, we now have to contract always with corresponding adjustments being linked in some way, shape or form. We also find that from the buyers, there's more interest in having corresponding adjustments, or at least the option to have corresponding adjustments as well. So I think that's the biggest impact. For Vitol as a broader business, shipping coming into the EU ETS, the Singapore tax scheme, CBAM, that has then a broader impact across the rest of our businesses. So it just becomes a question that for Vitol, carbon is a trading book in and of itself, but carbon starts to permeate all the other books that Vitol has and starts to create more risk and opportunities for the different books as well. I think one of the questions on the panel I was on was what could governments do to improve markets? And I think I would repeat the same thing. Create clear rules. Create clear rules and regulations. Financial markets, trading markets, they're all based on these are the rules. Look for the opportunities based on those rules and then act accordingly. And then, frankly, place your bets. You'll get some wrong, you'll get some right. But I think if you have a clear understanding of what is allowed, what's acceptable, what's expected, then everybody will behave accordingly. That will then release capital into these markets. Releasing capital adds additional risk. Risk has to be managed, and therefore, from a trading perspective, it adds to all the opportunity and froth, frankly, that needs to be dealt with.
And when you look ahead, where do you see some of the biggest opportunities to improve the carbon markets, the environmental markets right now? Is it better education? Is it better market infrastructure, better financial technology? I know you'd love to see regulation come through that's clear. I think there's a question of does one hold one's breath for that? What do you do in the interim?
Yeah, so I think, as I was saying, the market's really voting with its feet. So we are continuing to deploy capital, to deploy risk in the absence of this clarity, because to some extent, you have to follow what you think the trends are going to be, but it almost ends up being a bit more like venture capital rather than pure trading. You have to say to yourself, look, I'm not going to put all my eggs in this basket, but I have to at least have some exposure to all of these because it might turn out that this is the one that rockets because it gets accepted in regulated market X. This one gets rejected in regulated, and you just have to accept that it's a basket of risk that you're putting on and you apply it accordingly. So I don't think it creates a break from us approaching things, but would it accelerate if we had more clarity? Then definitely, because the banks would be able to be more active, we'd be able to do more refis of our projects and development, etc., and therefore recycle and deploy our capital again.
And I find that last point you made really fascinating, the venture capital aspect to it, 'cause people are often arguing, are these commodity markets? What kind of markets are these? But that's a point I don't think a lot of people are stressing enough. There's a certain venture capital aspect to this at this stage. I wonder if you could discuss that a little bit more.
Yeah, sure. So I think, if you look at the myriad of different, gold standard archery, there's a myriad of different programs that you can put your credits under. There's a myriad of methodologies. There's a myriad of geographies. So I think you just have to, again, in more in that venture capital way, it's venture capital that feeds to a commoditized flow. Now, why would I call it venture capital? I call it venture capital because ultimately you don't know which one's going to win. You're trying to make intelligent bets, but you just have to accept some of them will be duds and it'll be a disaster. So they'll still generate a commoditized flow, but maybe a commoditized flow that's not worth very much or that nobody wants, which is okay, fine. And then you just have to expect or hope that your marginal cost of production on the ones that do succeed is able to fund and frankly pay off the ones that failed.
My name is Alistair Weir. I'm head of environmental markets at Abex Exchange. I think it's an interesting time. If you speak to the market as a whole, I think we're kind of at a point where we're starting to see light at the end of the tunnel. After what was arguably a pretty slow 2023, Michael's suggesting that we've kind of hit that kind of bottom in the market. Prices are looking to be on the rise. Volumes are picking up. I mean, some of the exchange-traded contracts are starting to look more liquid than they were even 6 months ago. And I think that's down to really a number of factors. And the tools that the market has at their exposure is obviously much better than it was 12, 24 months ago. I mean, obviously, we've had great news come out of SBTI around use of voluntary carbon credits for Scope 3 emissions. We've seen ICBC make great progress on CCPs, announcing a number of eligible standards. VCMI is obviously doing great work around claims. So a lot of the pieces of the puzzle that the market was waiting to fall into place are now there. And that doesn't say anything about the likes of insurance products, new methodologies the market is developing. So I think it's an exciting time for the market as a whole. And I think there's suddenly a lot more optimism. And hopefully that allows more capital flow into the market in the coming year. We've been very busy the last 12 months kind of canvassing the market, trying to understand the kind of contracts that they feel the market needs. And so we've landed on 2 contracts to begin with. One, which is a CORSIA Phase 1 contract. We feel that's very, very much needed for the market as a whole. Obviously, airlines have compliance obligations, and they're used to having traditional risk mitigation tools. They obviously have big jet fuel hedging strategies. And so taking their expertise and transplanting that into voluntary carbon markets is obviously a logical fit. So we'll be launching that shortly. And then separately, we've evolved our voluntary carbon offering. So we have a nature-based solutions contract called Jurisdictional RED. This is a kind of evolution of project-based RED. So for the better part of the last 5 years, we've obviously heard a lot about nature-based avoidance. That's largely been through RED Plus projects. And obviously, I think we're all aware of some of the criticisms the market has faced around baselines, additionality, and leakage. And so moving from that project-based approach to a jurisdictional approach really solves a lot of those problems. And so we feel that's really the way the market will move towards over the coming years.
And it's been fascinating to me, at this conference and others, there's so many carbon markets are really becoming more plural in a way. We've heard a lot about new compliance systems, compliance schemes being developed by other countries, carbon tax being introduced, Europe kind of exporting its own policy framework through the CBAM. I'm curious, when you look at the development of carbon markets broadly, what do you make of this kind of growing plurality of approaches that we're seeing?
So, you're absolutely right. We're moving from a singular market, the CDM era, to a very, would almost say, fragmented market. In the voluntary space, you're seeing an abundance of new standards popping up. We're obviously seeing new methodologies being developed. And then beyond that, I would say probably the most promising trend is that of regional compliance markets. Obviously, the EU for a number of years has had a very successful ETS program. We've seen Colombia implement one. Singapore has obviously now put into place its carbon tax. And so I think it's one of the big demand drivers going forwards. Compliance type schemes are going to be really, really where the action takes place.
And how do you see the role of a futures exchange like Abex in working with those developing markets?
Well, if you look at any other commodity market, obviously having price transparency, having a price curve, allowing for hedging and risk mitigation, that's the fundamental of a market. And today, if you look at voluntary carbon markets, probably 90% of trades happen on an OTC spot basis, which doesn't necessarily serve the market particularly well. Project developers need to have an understanding of where their credits will price 2, 3, 5 years from now, as we've heard. Unlike almost any other commodity market, the investment payback and the project life cycle can run into the decades. And so in that particular case, having that price curve, having price visibility over a longer duration is obviously incredibly required.
And you're not only seeing the panels, you're of course having all the conversations around the conference as well. And I'm curious, from those conversations, when you think about where the big opportunities are in terms of bringing in new markets, new market infrastructure, new technology to really kind of help these markets develop and move forward, where are you seeing some of the bigger opportunities right now?
So I think probably at the end of the day, the biggest challenge the market is going to face is kind of data sharing and data transparency. If we look at CBAM and the reporting requirements that imposes upon the market, that's obviously a very complicated problem to solve for. And today, I don't think the market necessarily has all the tools that it needs at its disposal to really share data across a supply chain. So I think if I look at what are some of the more interesting solutions that maybe are on the horizon, particularly around data transparency, data sharing, and having kind of granular data on a commodity. So what does the carbon concentrate of a steel shipment look like? What is the water the requirement of that product. And being able to share that across supply chain partners is going to be, I think, a game changer going forwards.
Thanks again to all of our guests and to the Financial Times for partnering with us at their FT Commodities Global Summit 2024 in Lausanne, Switzerland. We hope you enjoyed the episode. If you would like to listen to the full interviews, they're available on our website, smartermarkets.media, on the Smarter Markets Presents media page. They're also available on our second podcast channel, Smarter Markets Presents, available on all major podcast platforms. We'll be back this Saturday morning with our regularly scheduled podcast. We hope you'll join us.
This episode was brought to you in part by Abax Exchange. Market participants need the confidence and ability to secure funding for resource development, production, processing, refining, and transportation of commodities across the globe, with markets for LNG, battery metals, and emissions offsets at the core of the transition to sustainability. Abax Exchange is building solutions to manage risk in these rapidly changing global markets, facilitating futures and options contracts designed to offer market participants clear price signals and hedging capabilities in those markets essential to our sustainable energy transition. Abax Exchange, bringing you better benchmarks, better technology, and better tools for risk management. This episode is brought to you in part by Base Carbon. It's time to get serious on carbon. Learn more at basecarbon.com. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.